What a lovely day, future CPAs, because today is another day to learn and grow into a person we aspire to be. Our discussion will revolve on Notes Part 1, Chapter 7 in Zeus Vernon Millan's Intermediate Accounting 3. Chapter 7 includes accounting policies, changes in estimates and errors, and events after the reporting period. There are also related standards that will be involved in the discussion, which are Past 1, Presentation of Financial Statements, Past 8, Accounting Policies, Changes in Estimates and Errors, and Past 10, Events after the reporting period. Also, by the end of the video, you are expected to state the relationship of notes with the other components of a complete set of financial statements, define and give examples of change in accounting policy, change in accounting estimate and error, differentiate between the accounting treatments of the following: change in accounting policy, change in accounting estimate, and correction of prior period error. Define events after the reporting period, and lastly, state accounting requirements for events after the reporting period. Notes. The notes or notes to the financial statements is an integral part of a complete set of financial statements because it provides information in addition to those presented in other financial statements. Information in the other financial statements shall be cross-referenced to the notes. As we all know, notes has all the supporting information about the items that is written in other financial statements. Other financial statements is referring to the balance sheet, income statement, cash flow statements, and statements of shareholders' equity. Notes are cross-referenced in these statements because it should contain the in-depth explanation and computations, and it should be parallel and satisfies those that are written in the financial statements. Past 1 requires it to be in a systematic, detailed manner, and that's why in the illustration here, if we click the full link indicated below, we will see that the notes part occupies a broad portion of their financial statements. Notes are normally structured as follows. First, general information on the reporting entity. Second, statement of compliance with the PFRS and basis of preparation of financial statements. Summary of significant accounting policies. This aggregation or breakdowns of the line items in the other financial statements and other supporting information. Other disclosures required by PFRS, and lastly, other disclosures not required by PFRS but the management deems relevant to the understanding of the financial statements.
Accounting policies, ito yung mga standards, principles, rules na dapat consistent na ina-apply kapag gumagawa at nagpe-present ang isang entity ng kanilang financial statements. When selecting and applying accounting policies, entity shall refer to the hierarchy of reporting standards. Yung hierarchy na sinasabi rito, alam ko familiar na tayo dahil sa conceptual framework pa lang ay nakikita na natin to. To account transaction, ang pinakaunang pagbabasehan ng isang entity ay ang PFRSs, and that also includes past and interpretations. In the absence of PFRSs, management uses its judgment in developing and applying accounting policies. In making that judgment, management considers the applicability of the references na ipapakita next slide. Pinapayagan ng Past 8 ang change in accounting policy kung required by PFRS at magre-result ito in more reliable and more relevant info. Change in accounting policy usually results from a change in measurement basis. For example, a change from FIFO to weighted average cost formula for inventory. May tatlong accounting treatments sa changes in accounting policy. Ang unang pagbabasehan ng isang entity kapag nagkaroon ng pagbabago sa accounting policies ay ang transitional provision, at kapag walang transitional provision, pwede nilang gamitin ang retrospective application. At kung ang retrospective application is impracticable, meaning hindi talaga pwede kahit anong gawin, ang last option is yung prospective application. Tandaan nyo na ang retrospective application ay pag-a-apply ng bagong accounting policy na para bang lagi mo siyang ginagamit. Changes in accounting policies has an effect on the beginning balance of retained earnings kung accounted siya retrospectively. Ito yung hierarchy of reporting standards. You have PFRSs, judgment, and yung mga pwedeng i-consider ng management tulad ng conceptual framework and other standard setting bodies.
So here is an illustration of a change of cost formula. In the illustration, ABC company decided to change from the average cost formula to FIFO cost formula. inventory balances would be in January 1, the average is 1 million, and in FIFO cost formula is 1.2 million. In December 31, the average is 2 million, and the FIFO is 2.1 million. Income tax rate is 30%. So the question is, what is the net cumulative effect of the accounting change in ABC's opening retained earning balance? The solution would be the average inventory on January 1 for 1 million and in the FIFO inventory for January 1 of 1.2 million. In order to get the cumulative effect plus of tax, subtract the average inventory from the FIFO inventory. The result would be an increase of 200,000. Multiply by 70% in order to get the net of tax of 140,000. To journalize this transaction, debit the inventory account for 200,000, which is the amount of cumulative effect gross of tax. Credit retained earnings for 140,000, the amount of cumulative effect net of tax. And according to past 12 income taxes requires the recognition of deferred taxes on adjustments to the opening balance of retained earnings. So with that, i-credit natin yung deferred tax liability for 60,000. Where did we get the 60,000? It is from the 200,000 inventory multiplied by the 30% tax rate.
A voluntary change in accounting policy, as stated in the screen, it is a change that is requested or made by the entity itself to adopt to other standard-setting body in the absence of PFRS that specifically applies to a transaction. A voluntary change in accounting policy is accounted for by retrospective application. Retrospective means adjusting the opening balance of each affected component equity for the earliest prior period presented and the other comparative amounts disclosed as if the new accounting policy had always been applied.
A change in reporting entity is a change from reporting as one type of entity to another type of entity. So presented naman yung mga example. Dito, sa last example, may mga pagbabago na nangyayari sa mga companies na included sa combined FS, may mga umaalis at may mga bagong pumapasok. Yung mga change na nabanggit ay accounted by retrospective application. Ang change in reporting entity is not specifically mentioned in the PFRSs. Ang na-mention lang doon ay yung change in accounting policies and change in accounting estimate.
Changes in accounting estimates normally results from changes in how the expected inflows or outflows of economic benefits are realized from assets or incurred on liabilities. Changes in accounting estimates result from new information or new developments and, accordingly, are not correction of errors. The effect of a change in an accounting estimate is recognized prospectively. Prospective application means recognizing the effects of the change in profit or loss, either in the period of change or in the current reporting period in form of catch-up adjustment, or the period of change in future periods if both are affected, or the current and future reporting periods. For example, change in useful lives affects depreciation charges in both current and the future reporting periods. Note that under prospective application, the beginning balance of retained earnings and the previous financial statements are not restated.
Here is an illustration about changes in accounting estimates. You can pause the video for a while to be able to read and further understand the situation. If you pause the video, welcome back. So let us now solve the problem. For the step 1, kukunin muna natin yung carrying amount ng equipment as of the date of change. So, historical cost of 1 million less residual value of 100,000 equals 900,000 and divided by its estimated useful life of 20 years. Then, makukuha na natin yung depreciation expense based on straight line method na 45,000. Then again, the historical cost of 1 million less accumulated depreciation. Nakuha natin siya nung nakuha natin yung 45,000 times 5 years, 225,000. At makukuha na natin yung carrying amount on January 1, 2006 na 775,000. And for the step 2, carrying amount natin ng January 1, 2006 na 775,000, ilalas natin sa panibago niyang residual value na 50,000. Then the revised depreciable amount will be 725,000 multiplied by sum of the year's rate na 4/10. Then makukuha na natin yung depreciation expense for 2006 na 290,000. Makikita din natin dito sa illustration kung paano natin nakuha yung 4/10. And the entry to record the effect of the change in estimate in 2006 in profit or loss is as follows. debit depreciation expense of 290,000 and credit of accumulated depreciation of 290,000.
Relationship between accounts. In a periodic inventory system, the following relationship between accounts can provide guidance in determining the effects of counterbalancing errors and profit or loss. As you can see in the other relationships, it is either direct or inverse relationship. The difference between direct and inverse relationship is that direct relationship means if ending inventory is understated, profit is also understated. While inverse relationship means if an account or ending inventory is understated, the related account or the cost of goods sold is overstated. And note that the relationships shown above are applicable only under the periodic inventory system, not under the perpetual inventory system, because under perpetual inventory system, cost of goods sold is determined independently of the physical count of ending inventory, while in periodic inventory system, cost of goods sold is a residual amount after deducting ending inventory from total goods available for sale.
Asset-related account and profit has a direct relationship. Ano nga ba yung asset-related account? It pertains to prepayments and accrual for income. Some of the examples is the error on prepaid asset or error on accrued income. However, there is also a liability-related account. Liability-related account has an indirect relationship with profit. Liability-related account pertains to unearned items, unearned rent, advances from customers, deferred income, and accrual for expenses.
For you to read the problem and further absorb it, you may pause the video for a moment before proceeding. So sa problem na to, ang requirement ay hanapin ng correct profits in 20x1 and 20x2 and ang correct retained earnings in 20x1 and 20x2. In requirement A, there are corrections, so understatement is corrected by addition while an overstatement is corrected by deduction. Since all the needed information is already shown in the solution, just simply add the understated amount and deduct the overstated amount. Then you will get the amount of the net adjustment to profit in 20x1 and 20x2 and simply add or deduct it in the unadjusted profits. And you will get the correct profit in 20x1, which is 1,290,000, while in 20x2 is 1,890,000. In requirement B, as you can see, the error in 20x1 inventory has no effect on 20x2 since its effect has already counterbalanced. The 20x2 year-end retained earnings is affected only by the non-counterbalancing error or an error in equipment. So just simply get the amount of net effect of errors on retained earnings in 20x1 and 20x2 and add it in the unadjusted retained earnings, and you will get the correct retained earnings in 20x1, which is 2,490,000, while in 20x2 is 4,380,000.
Ang events after the reporting period is yung mga events or dates between the end of the reporting period and the date when the FS are authorized for issue. Ang date of authorization of financial statements ay yung date kung kailan pinahintulutan ng management ang pag-issue ng FS regardless kung yung authorization is final o nangangailangan pa ng approval ng other parties.
In our screen is an example case for the events after the reporting period. You may pause the video for a while to be able to read and absorb the case. So if you pause the video, welcome back. The analysis for this case is that the events after the reporting period will include the events occurring from January 1, 2002 to February 5, 2002 because February 5 is the day when financial statements were authorized for issue.
Now, let's move on to errors. Alam naman nating lahat kung ano ang ibig sabihin ng errors. Pag sinabi nating errors, merong mga naging pagkakamali, merong misapplication accounting policies. So, financial statements do not comply with PFRS if they includes either material or immaterial errors. Pag sinabi natin na material error, ito yung mga errors made unintentionally, but if immaterial errors, ito naman yung mga errors made intentionally. Intentional errors are fraud. There are two types of errors according to the prior period of occurrence. First is the current period errors. These are errors na discovered during or after the current period but before the financial statements are authorized for issue. Next is the prior period errors. Same with the current period error. Ito naman ang error na na-discover during or after the current period but before the financial statements are authorized for issue. But these are corrected by retrospective restatement. Ano nga ba yung retrospective restatement? Pag sinabi natin retrospective restatement, meaning tinatama mo yung mga prior period error na as if yung error na yun ay hindi nangyari. Sa retrospective application naman is mag-apply ka ng new accounting policy na as if na yun talaga yung in-apply mo from the very first start. If impossible naman na ma-determine yung cumulative effect of a prior period error sa beginning ng current period, the entity may correct the error prospectively from the earliest date practicable.
Illustration 1 for current period error. You can pause the video to read the problem. Ang requirement na hinihingi is correcting entries assuming books are still open and books are already closed. Ignored income taxes. Sa requirement A, ang magiging entry ay debit advertising expense for 100k and credit advertising payable for 100k. Dahil kapag sinabing books are still open, meaning hindi pa nagagawang closing entries, that is why pwede pa natin gamitin ang mga nominal amounts. Sa requirement B, hindi na natin pwedeng gamitin ang nominal amounts dahil nagawa na ang closing entries, meaning ang mga nominal amounts ay mako-close out na at natatransfer na siya sa retained earnings. Kaya ang entry ay naging debit, retained earnings for 100k and credit advertising payable for 100k. Continuation, hindi in-ignore yung tax at ang tax rate is 30%. To get the income tax payable, you need to multiply the 400k to 30% and then you can squeeze the amount that should be recorded to retained earnings. At ganun na yung naging entry. For the illustration for prior period error, on January 15, 20x3, while finalizing its 20x2 financial statements, ABCco discovered that depreciation expense recognized in 20x1 is overstated by 400k. Prior period errors are corrected by adjusting the beginning balance of the retained earnings for the earliest period. Kaya ang entry on January 15, 20x3 is debit accumulated debt for 100k and credit retained earnings for 100k.
There are two types of errors. First is errors in principle. An errors in principle is more likely to be committed when an accountant does not have a good understanding of accounting concepts and terms used in accounting. Example of errors in principle is when treating the purchase of an asset as an expense. There is also intentional errors, or also known as fraud. Second is clerical and similar errors. These include mathematical mistakes, oversights, and misinterpretations of facts. Example of these are the following. First, transplacement error. It is the incorrect increment or decrement of the digits in an amount. Second, transposition error. It is when the digits in an amount are interchanged. Third, errors of omission. Omission to record goods sold to a vendor. Omission to record asset purchased, and etc. Fourth, errors of commission. The erroneous credit is compensated by the erroneous debit. This error will not be revealed by the trial balance. Fifth, accounting system error. For example, there is a bug in the computer program wherein the program is not functioning well. All you have to do is do system maintenance to fix the bug. Lastly, counterbalancing and non-counterbalancing errors that will be discussed by Marvin and Camille on the next slides.
As we can all see, ang counterbalancing errors ay nangyayari kapag may nakamit na error sa present reporting period and it remained uncorrected. Automatic na kailangan siyang i-correct at i-offset sa susunod na accounting period. Examples of counterbalancing errors includes errors relating to the following in the screen. A simple sample situation is this. Kapag ang profit mo sa year 1 ay overstated, automatic sa year 2 kailangan mo siyang maging understated to amend the error in year 1. However, the profit in year 3 will be unaffected because the effect of the error in year 1 was already been counterbalanced in year 2. The statement of financial position in year 1 is considered erroneous, but year 2 and year 3 will be unaffected.
Non-counterbalancing errors ay ang polar opposite ng counterbalancing errors. Ang non-counterbalancing errors affects the profit or loss only in the period the error was committed. However, the balance sheet remains erroneous hanggang hindi pa nadidiscover o natatama ang non-counterbalancing error. Makikita nyo sa table yung sa profit, overstated lang siya sa year 1, hindi naapektuhan yung mga susunod na years. Pero sa balance sheet, erroneous siya hanggang hindi pa nadidiscover at natatama yung error. Yung mga nakalista dyan ay yung mga example ng non-counterbalancing errors.
Two types of events after the reporting period. First is the adjusting events after the reporting period. These are those that provide evidences that existed at the end of the reporting period. Kailangan i-adjust yung financial statement sa ganitong event. An example of this is the discovery of fraud or errors that indicate that the financial statement is incorrect. Next is the non-adjusting events after the reporting period. These are events and conditions that arose after the reporting period. Hindi nito nare-require na i-adjust yung amount sa financial statement, however, kapag relevant sa user. This is disclosed on financial statement. An example of non-adjusting event is casualty losses occurs after the reporting period, but before the financial statements were authorized for issue.
Adjusting events after the reporting period are the events that requires adjustments of amounts in the financial statements. Mapapansin natin sa examples na nakalagay dito, ang included lang sa adjustments ay lahat ng events na nangyari bago pa matapos yung reporting period or sa mismong araw ng pagtatapos ng reporting period.
Ang non-adjusting events after the reporting period ay yung mga event na hindi nagre-require ng adjustments. For the name itself, non-adjusting. Nagpro-provide to ng mga condition na nag-a-arise after the end of the reporting period. Pero dinidisclose sila sa FS kung relevant sila sa users. Ang mga examples nito ay yung mga changes in fair values, foreign exchange rates, yung casualty losses na nangyayari after the reporting period but before the authorization date, yung declaration of dividends.
Dividends. If dividends are declared after the end of reporting period but before the financial statements are authorized for issue, the dividends are not recognized as a liability at the end of the reporting period because they do not meet the criteria of a present obligation. It is in accordance with PAS 37 provisions, contingent liabilities, and contingent assets. Such dividends are disclosed in the notes to the financial statements in accordance with PAS 1, presentation of financial statements. In going concern, PAS 10 prohibits the preparation of financial statements on a going concern basis if management determines after the reporting period either that it intends to liquidate the entity or to cease trading, or that it has no realistic alternative but to do so. Entities will therefore need to give careful consideration as to the appropriate basis of preparation bearing in mind their own specific circumstances and to have insights into matters to be considered when a going concern basis is not appropriate.
Here is an example regarding identifying adjusting and non-adjusting events. In these transactions, the end of the reporting period ends on December 31, year 1. Sa mga given transactions, the only adjusting event is letter E. On February 10, year 2, ABC received notice of litigation in relation to an accident that happened on December 31, year 1. ABC estimates a probable loss of $200,000. A to C are non-adjusting events because these are conditions that arose after the reporting period, so the solution would be the estimated liability on pending litigation of $200,000. With that, the total adjusting events is $200,000.
The following are disclosed in the notes. A. Date of authorization for issue and who gave the authorization. B. An update on the disclosures to include the effects of adjusting events. C. Non-adjusting events that are material, including the nature of the event and an estimate of its financial effect or statement that such an estimate cannot be made. And that's it for our discussion. But before we officially end, we would also like to leave you a very timely reminder from Proverbs 3 verses 5 to 6. Trust in the Lord with all your heart and lean not to your own understanding. In all your ways, acknowledge Him and He shall direct your paths. Thank you and God bless us all.